Okay, I wanted to do a quick review of the entries from Chapter 5 for our merchandising company. Remember, we'll do the entries assuming the companies are on the perpetual inventory method. So that should have made you think, oh, we need 2 entries at each sale and return. And we're not going to do the discounts. So just do the very basic entries. So we need 2 sets of entries. What do you do when you buy inventory? And then what entries do you do when you sell inventory? So the problem on the test will be 2 separate problems. You'll just have to do the entries for purchase first and then the entries for sale. Okay, so we could do where you buy inventory and sell some and return some and everything all together, but I won't do that. I'll just keep it simple. Okay, so the first entries here are when we purchase inventory. And remember, try to think back in Chapter 2. These aren't totally new entries you've never heard of before. They're related to the ones you already know from Chapter 2. So we're going to assume that we purchase inventory. Just put the problem up here. Okay, so for this problem, we purchase inventory costing $6,000, and the terms are 210 net 30. Now I said we're not going to do discounts, so you don't have to use those in the calculations, but you should know what this means. It means the company, company has offered us as purchasers, we can take a 2% discount if we pay within 10 days, but we can wait the net invoice, we can pay the whole thing, but we have to pay within 30 days. So our deal or no deal is take 2% if we pay in 10 days, or pay the whole invoice in 30 days. You should know what these numbers mean, but we're not going to pay within the 10 days, so we don't have to take the discount in our entry. Okay, but the reason I wrote this up here, that does mean, since we see these terms, we know that we purchased the inventory on account. We did not pay cash immediately. That's why that's important there. Okay, so let's say we did this on March 3rd. Okay, so the entry then is just on 5/3. This is just buying inventory on account. We already know this from Chapter 2. So the asset now is that we're buying is inventory. So we're going to debit inventory for $6,000, and we're going to credit accounts payable. We're going to pay later. That's what these terms mean. We're going to pay later. It's on account. Now, in Chapter 2, we bought all kind of assets on account. Supplies, equipment. So this entry is not really that new. What is new is often something's not right with the inventory. It's not exactly the high quality one in our store. So we might return it. So let's say that we return on 5/10, we return $1,000 of the inventory. Remember, we're going to assume we're a shoe store, so we sent $1,000 of the inventory back to Nike. We didn't like the color or something. Okay, we didn't want to sell it in our store. So on the purchase side, this is easy. We just undo part of this entry. We're just flipping this over. Okay, so we're going to debit accounts payable because we owe less money than we did before. And we're going to credit inventory because we sent the inventory back. So we just undid this purchase. The inventory got shipped back, and we owe less money now. Okay, and then the only thing we have to do then, let's say we waited more than 10 days, but before the 30 days was out, on 6/2, we paid off the accounts payable. Okay, so these are the 3 entries: buy inventory, return inventory, pay off the accounts payable. Again, we already know how to pay off the accounts payable. We're just paying cash out, so cash is credited, and we're gonna debit the accounts payable. Remember, this is a liability, so this is making our liability go down, we owe less money. So, and now we just have to figure out how much do we still owe. We're not gonna pay the whole 6,000 because we have this return. So I like to do a little T account on the side. You don't have to, but I like to see how much we actually owe. So after the return, we owe $5,000. So that's how much we're going to pay off. $5,000. We're going to debit the accounts payable and credit the cash. So on the purchase side, it's pretty easy. Buy inventory on account, flip it over if we return some of the inventory, and then pay off the accounts payable. Just make sure you figure out by looking at these two accounts payable up here how much we still owe after the return. We only owe $5,000. Now, often in this chapter we asked you, what do you do if you pay the shipping to come from Nike? And remember, any cost to get the inventory to our store and ready to sell has to go into the inventory. So the cost of the inventory should be any cost to get it to our store and in the condition we want to sell it. So if we pay shipping to our store, let's say we paid $500 to get this shipping to our store. Doesn't really matter the day. Let's just say we did that on 5/5. We paid cash for it. We'll just assume we paid cash. Make sure we know that we should debit inventory here. Okay. So that's the key to this part. Is when you ship to the store, then this debit has to be to inventory, not to shipping expense or freight in or anything like that. It should go to inventory. Okay, so those are the entries on the purchase side of the inventory. Now let's see what happens when we do the selling. Now remember, on the sales side, let's say we make up a problem here. Say we sold inventory for $28,000. That cost $11,000. And we're on the perpetual method. And the terms are 115 net 45. So again, we're not going to do the discounts. We're not going to assume our customers don't pay us within the 15 days, so they don't get the 1% for paying within 15 days. They're going to pay us the whole thing after 45. So this won't really affect the entries, but the fact that these are here means that our customers bought on account. So we're going to use accounts receivable. They didn't pay us cash. That's what these credit terms indicate. So that's the only reason it's in the problem here. So you remember that the purchase was on account. Now this perpetual method is really important on this part one, because remember the perpetual method means we update our cost of goods sold at every sale. So when you see this, think, oh wait, we need 2 entries at every sale and every return. It should help you remember that when you see 2 numbers in the problem, this is the sales price and this is the cost. When you see those 2 numbers, think, oh yeah, I need 2 entries, okay? So let's say that the sale took place on 7/2, and so again, this is on account, so we're going to debit accounts receivable and credit sales for the sales price, $28,000. So we're going to debit accounts receivable and credit sales for the sales price number. Okay, now remember in chapter 2 when we did work on account, we would put accounts receivable and service revenue. Basically this is the same entry, same revenue entry. We just changed this to sales because instead of doing service, we're selling inventory, okay? So this is still similar to an account entry you knew in chapter 2. But we're on the perpetual inventory method, so don't forget, we also have to update our cost of goods sold at the same time, okay? So remember, the inventory is gone, so we're gonna decrease our inventory. That's an asset, so it goes down to the credit. So our inventory goes away, and we're gonna move it into cost of goods sold. So we're gonna debit cost of goods sold and credit inventory for the cost. So we need 2 entries at every sale. That's what we mean here. One to record the sales price, accounts receivable and sales, and one to record the cost of goods sold and inventory. This is an expense, so this is going up. Expenses, we usually think are debits, so that makes sense. And inventory is going out. So picture in your mind what's happening. We sent this inventory to our customer, okay? One thing students sometimes get these accounts mixed up, okay? Accounts receivable and sales use sales price numbers, and cost of goods sold and inventory use cost numbers. And really never the twain shall meet. You don't really put inventory and accounts receivable in the same, or sales and cost of goods sold. Those really wouldn't go in the same because these use sales prices and these use costs. So those are separate things. So I often see strange cost of goods sold and sales in the same entry. That doesn't really go together. Those are 2 different prices. Now, just like we did on the purchase side, what if our customer returns some of the inventory to us? Maybe the shoes didn't fit from our shoe store or something. Okay? So when we did the purchases, we just flipped over the entry. Here it's almost flipping over this and this, almost. But don't debit sales. That'll help you remember which one changes. Don't debit sales, because we want to keep track of our returns for quality control purposes. So we're going to use sales, returns, and allowance instead. So let's say that, we'll just put the numbers over here. Let's say $3,000 of shoes were returned, and they originally cost $1,000. So again, just like up here, we need the sales price and the cost. This is the sales price of what the customer returned, and this is the cost. So let's say that happened on 7/8. Again, we need 2 entries of each sale and each return. So we're going to kind of undo this sale. So we're going to debit, but I said don't debit sales. We're going to debit sales, returns, and allowances. This is a contra revenue account. Okay, revenue has a normal credit balance. This contra revenue account has a normal debit balance. It goes against sales on the multiple step income statement. So that's for the sales price. And the rest of it is just flipped over. So we have to reduce the accounts receivable. Our customer doesn't owe us that much money. Excuse me. So we have to reduce their accounts receivable. They don't owe us as much money. And then we're also going to do the second entry to flip this over. The customer sent the inventory back. We have to debit inventory. It came back. We're going to put it back on our shelves. So this is the cost of the inventory that was sent back. We also have to reduce cost of goods sold. Like that. We have to reduce cost of goods sold because we have to undo part of the sale. This keeps track of all this, the cost of all the inventory we sold. Well, we didn't sell this anymore, so we're reducing it. Now, this does violate one of our rules. This is an expense, and we're crediting expense. So I always said, expenses are debits, expenses are debits, expenses are debit. Okay, but this is one of our exceptions. When you're returning, when customers return inventory to us, we do credit this expense. And then, I didn't allow very much room here, the last entry that we need to do is our customer's going to pay their money. Okay, again, we already know this entry. Again, we're not paying in the discount period. We don't have to worry about that. Let's assume they paid us on 8/13. That just means we got a check in the mail, right? So we already know this from chapter 2. We debit cash, we got a check in the mail. And the accounts receivable has to go away. They don't owe us any more money. This is a reduction here. We got to reduce the customer's account to us. So accounts receivable goes down. But again, don't go back up here and say, oh, they paid us $28,000. They're not going to pay us $28,000 because of this return. So again, you might want to do a little T account here. Accounts receivable. They owed us $28,000, but after the return of $3,000, they only owed us $25,000. So they're going to pay us $25,000. We're going to credit that so their account goes away. So $25,000. It's a debit, and $25,000 is the credit. So then if we post this, our customers don't owe us any money is what should happen there. Okay, so these are the entries for the purchase side under the perpetual method. Remember, as soon as you see this perpetual method on the sales side, I think I said purchase side, on the sales side, remember you need 2 entries at each sale and 2 entries at each return. If we did pay the shipping to ship it to our customer, that's not coming to our store, that's going away from our store. So when you pay to go away from your store, that's just an operating expense. That's just shipping expense, delivery expense. That doesn't go through inventory. That just goes to an operating expense called shipping expense. Now, I do want to see if I have a little room over here. I do want to see, what if I asked you, what is our gross profit from this transaction? I might ask that on the test. What is our gross profit from these entries here? Okay, remember, gross profit, that if we start our income statement, we would take sales. In this case, sales is $28,000 on this transaction. And then we subtract sales, returns, and allowances, and sales discounts. So our sales, returns, and allowances was 3. We didn't have any discounts. So remember, our net sales would be $25,000. And then to get to gross profit, we need to subtract our cost of goods sold. Remember, this is the sales price, and this is the cost. This is how a shoe store makes money. They buy low and sell high. So how much is the cost of goods sold? Well, we have 2 numbers here. So again, if it was me, I would probably do a little T account. Cost of goods sold. Started out at 11. But then if we post this credit to cost of goods sold, it's 1,000. So after the return, our cost of goods sold is $10,000. So we're going to subtract $10,000, and our gross profit is $15,000 in this example. Okay, so you kind of see how the entries tie in to the top of the income statement. Okay, that's a quick review for you to study for the exam.